I was analyzing the latest gold-silver ratio data when something caught my attention that made me immediately call Francis Hunt, one of the most respected precious metals analysts in London. The ratio had just hit 87.1, a level that historically signals we're entering what he calls the caustic contagion phase, where silver doesn't just rise, it explodes parabolic. "Claude," Francis said, his voice carrying that urgency I've learned to pay attention to, "we're not just looking at a normal precious metals rally anymore. We're witnessing the convergence of three forces that have never happened simultaneously in modern history: ratio contagion, industrial supply shock, and technological revolution. When these align, silver doesn't move 20% or 50%, it moves 300% to 500% in months." But here's what made this conversation truly extraordinary. Francis wasn't just talking about technical chart patterns or historical cycles. He was talking about solid-state battery technology that is about to consume silver at rates that could literally deplete global supplies within 18 months. We're not discussing investment opportunity anymore. We're discussing the last chance to acquire a metal that's about to become genuinely scarce. I've been tracking precious metals for over a decade, but I've never seen Francis this animated about silver's potential. "The people selling their silver right now," he told me, "are making the same mistake as those who sold their Bitcoin at $3,000 thinking they were being smart. They're optimizing for small, temporary gains while missing the largest wealth transfer in commodity markets since the 1970s oil crisis." The mathematical evidence was undeniable. Every indicator Francis uses to predict major silver moves was not just flashing buy signals. They were screaming that we are about to witness the most explosive precious metals rally in living memory. And unlike previous rallies driven by financial speculation, this one is being driven by unavoidable industrial demand that makes the coming price explosion mathematically inevitable. Understanding the gold-silver ratio contagion phase. The gold-silver ratio has reached levels that historically trigger what Francis Hunt calls contagion phase, where silver price movements become disconnected from normal market logic and enter parabolic acceleration that can deliver life-changing returns in remarkably short periods. Historical context of ratio extremes. When the gold-silver ratio exceeds 80:1, silver historically outperforms gold by massive margins during the subsequent correction. At current levels of 87.1, we are in territory that has only occurred 4 times since 1980, and each time led to silver rallies of 200% to 400% within 12 to 18 months. The 1979-1980 rally saw silver rise from $6 to $49, when the ratio corrected from 89.1 to 16.1. The 2008-2011 rally took silver from 8 to 48 as the ratio fell from 84.1 to 31.1. The pattern is consistent. Extreme ratios create spring-loaded conditions where silver explodes upward with tremendous force. The contagion mechanism. Francis explains that contagion phase occurs when silver becomes so undervalued relative to gold that even small shifts in precious metals allocation create outsized silver demand. When investors move just 5% of gold holdings into silver, the mathematical impact on silver prices is enormous due to market size differences. Gold's market capitalization exceeds $15 trillion, while silver's total above-ground supply is worth approximately $1.4 trillion. When gold investors diversify into silver during ratio corrections, the relatively small silver market experiences demand surges that create parabolic price movements impossible in larger markets. Technical pattern recognition. The current gold-silver ratio chart shows classic characteristics of pre-explosion conditions: extended periods above 80.1, failed attempts to break higher, and increasing volatility that suggests the ratio is losing stability. Francis identifies these patterns as preceding every major silver rally since 1971. The ratio does not gradually decline. It collapses rapidly as silver catches up to gold performance with violence that surprises even experienced precious metals investors. Institutional allocation shifts. Major institutional investors are beginning to recognize silver's undervaluation relative to gold, with several sovereign wealth funds and pension systems increasing silver allocations specifically because of ratio analysis. When institutional money begins rotating from gold to silver, the resulting demand surge overwhelms supply in ways that retail investor buying cannot match, creating the mathematical foundation for parabolic price movements. The solid-state battery supply shock beyond ratio analysis, Francis emphasizes that solid-state battery technology represents the most significant industrial demand shock for silver in modern history, potentially consuming the entire global supply increment within 24 months. Battery technology. Silver requirements. Solid-state batteries require 10 to 20 grams of silver per kilowatt-hour of capacity, compared to 0 silver usage in current lithium-ion batteries. As automotive manufacturers transition to solid-state technology for improved safety and performance, silver demand could increase by 200-400 million ounces annually. Current global silver mine production totals approximately 840 million ounces annually, meaning solid-state battery adoption could consume 25-50% of total mine output for automotive applications alone, before considering existing industrial, investment, and jewelry demand. Manufacturing timeline. Acceleration. Major automotive manufacturers, including Toyota, Mercedes, and BMW, have announced solid-state battery production timelines beginning in late 2026 through 2028. This is not theoretical future demand. It's confirmed industrial consumption beginning within 12 months. Francis emphasizes that markets typically don't price in supply shocks until they become obvious, meaning silver prices likely haven't incorporated the reality of 200-400 million ounces of new annual demand entering the market starting in 2027. Supply response limitations. Unlike other commodities where higher prices stimulate increased production, silver supply is largely inelastic because 70% comes as byproduct of base metal mining. Even if silver prices double or triple, mine production responds slowly because it depends on copper, lead, and zinc mining economics. This supply inelasticity means that new industrial demand translates directly into higher prices rather than increased production, creating the mathematical foundation for explosive price movements when demand surges occur. Recycling reality. Check. Some analysts suggest silver recycling could meet increased demand, but Francis points out that automotive silver becomes locked in vehicles for 15-20 years, removing it from available supply during the crucial adoption period. Additionally, recycling rates for industrial silver applications remain below 30% due to dispersion and technological challenges, meaning recycled supply cannot offset the magnitude of new demand from solid-state battery adoption. Investment positioning. Avoiding the premature sale. Trap. Francis emphasizes that the most dangerous mistake silver holders can make now is selling prematurely due to short-term volatility or modest profit-taking, potentially missing the largest precious metals rally in decades. Understanding volatility versus trend. Silver's daily price volatility often triggers emotional selling, from investors who mistake normal precious metals fluctuations for trend reversals. Francis stresses that 5 or 10% daily moves are normal during major silver rallies and should not influence long-term positioning decisions. Historical analysis shows that investors who sold during temporary corrections within major silver rallies typically missed 60-80% of the ultimate price gains. The key is distinguishing between temporary volatility and genuine trend changes, the compound effect of early selling. When investors sell silver positions early in major rallies, they not only miss potential gains, but often struggle to re-enter at reasonable prices as momentum accelerates. Francis has observed this pattern repeatedly, where early sellers watch helplessly as prices move far beyond their exit points. The psychological difficulty of repurchasing an asset at higher prices than your sale price often keeps investors permanently sidelined during the most profitable phase of precious metal cycles. Institutional versus retail timing. Francis notes that institutional investors with longer time horizons typically buy silver during early phases of major rallies and hold through volatility, while retail investors often buy late and sell early due to emotional responses to price movements. This timing differential creates opportunities for patient retail investors who position early and maintain discipline during volatile periods that shake out less committed holders. Position sizing for volatility. Rather than selling entire positions during temporary corrections, Francis recommends appropriate position sizing that allows investors to hold through volatility without excessive emotional stress. This approach enables participation in major rallies, without the psychological pressure that leads to premature selling decisions that can devastate long-term returns from precious metals investments. The mathematical case for silver explosion. Francis Hunt's analysis relies heavily on mathematical relationships between silver supply, demand, and price that suggest current levels are unsustainably low given developing market conditions. Supply-demand arithmetic. Global silver demand totaled 1.24 billion ounces in 2285, while mine production plus recycling supplied only 1.18 billion ounces, creating a 60 million ounce deficit that was filled by drawing down above-ground inventories. Adding 200-400 million ounces of solid-state battery demand to existing consumption creates a structural deficit of 260-460 million ounces annually, equivalent to 30-55% of current mine production that simply doesn't exist. Price elasticity analysis. Silver's price elasticity of demand is extremely low for industrial applications, meaning manufacturers will pay significantly higher prices rather than substitute inferior materials or delay production schedules. This inelastic demand characteristic means that supply shortages translate directly into proportional price increases rather than demand destruction, creating mathematical relationships where 30% supply deficits could trigger 200-300% price increases. Inventory depletion timeline. At current deficit rates accelerated by solid-state battery demand, Francis calculates that available above-ground silver inventories could be depleted within 18-24 months, forcing the market into permanent shortage conditions. When inventories are exhausted, prices must rise to levels that either destroy marginal demand or incentivize dramatic increases in mine production. Both scenarios suggesting silver prices multiples higher than current levels. Historical price relationship. Francis points out that silver reached $40 in 1980 when facing supply pressures far less severe than current developing conditions. Adjusting for inflation and monetary expansion since 1980, equivalent silver prices today would exceed $200 per ounce. Current prices, around $30, represent massive undervaluation relative to both historical precedents and developing supply-demand fundamentals that suggest much higher equilibrium prices are mathematically inevitable, timing the explosive phase. While Francis believes silver explosion is mathematically inevitable, he provides specific indicators for recognizing when the parabolic phase begins and how to position for maximum benefit. Early warning indicators. Francis monitors several specific metrics that historically signal the beginning of explosive silver rallies. Gold-silver ratio breaking below 75.1, industrial silver premiums exceeding 15% over spot, and COMEX inventory levels falling below 100 million ounces. All three indicators are approaching trigger levels simultaneously for the first time since 2010, suggesting the explosive phase could begin within 3 to 6 months rather than years. Momentum acceleration. Signals. Once parabolic moves begin, Francis identifies acceleration patterns that separate normal rallies from explosive moves. Daily gains exceeding 8% becoming routine, industrial buyers competing against investors for available supply, and mainstream media beginning to cover silver shortages. These signals help distinguish between normal precious metals, volatility, and genuine explosive phases that can deliver extraordinary returns in compressed timeframes. Exit strategy. Considerations. While Francis is bullish on silver's long-term prospects, he emphasizes the importance of having exit strategies for portions of holdings when parabolic moves become unsustainable. Historical analysis suggests taking partial profits when silver reaches 10 or 15 times its starting point of major rallies, while maintaining core positions for potential further advances that could continue beyond logical stopping points. Geographic and product diversification. Francis recommends geographic diversification of physical silver holdings and avoiding concentration in any single storage location or dealer relationship during explosive price phases. Additionally, he suggests diversifying between various silver products, coins, bars, mining stocks, to optimize liquidity and to reduce counterparty risks during periods of extreme market stress. The mathematical evidence is overwhelming. The gold-silver ratio has reached contagion phase levels. Solid-state battery demand is about to create the largest industrial silver shortage in history. Supply response is limited by geological and economic constraints that make meaningful production increases impossible in relevant timeframes. Francis Hunt's analysis suggests we're witnessing the convergence of technical, fundamental, and technological factors that have never aligned simultaneously in precious metals markets. The resulting price explosion could dwarf previous silver rallies due to the unprecedented nature of developing supply-demand imbalances. The most dangerous mistake silver holders can make is selling prematurely due to short-term volatility or modest profit-taking. The investors who hold through the volatile early phases of this developing rally will likely be rewarded with gains that create generational wealth. For those still considering silver positions, Francis emphasizes that the window for reasonable entry prices is closing rapidly as institutional awareness of the supply crisis spreads and allocation shifts accelerate. This is not speculation or hope. It's mathematical analysis of supply and demand relationships that make explosive silver price movements virtually inevitable within the next 12-18 months. The contagion phase has begun. The supply shock is coming. The price explosion is building momentum. Hold your silver. The best is yet to come.